This is Quent Bilo with the continuation of budgetary planning. I'd like to focus on the operating budgets and some detailed calculations within it. So the operating budget involves sales budgets, production budgets, direct materials, usage and purchase budgets, and direct labor usage budgets. As we noted earlier, sales dollars are expressed in units and dollars, but it's the units we need to translate into the production budget and more detailed direct material and direct labor budgets. So we start with units and we proceed to quantities in dollars for direct materials and direct labor. Focusing on these three budgets, production, direct materials, and direct labor budget, given a sales budget, we'll make use of the base formula, the inventory flow formula introduced in notes in a prior chapter, which can be readily applied in this budgeting chapter. We can use units as well as dollars. We're not just restricted to using dollars through an inventory account. So the operating budget cycle begins with a sales forecast and proceeds to a production budget, materials needed to support that production budget, and the purchase of raw materials. Likewise, direct labor needed comes from or is derived from the production budget. Sales and the production budget are focused on finished good units, saleable units, and the materials and direct labor budget is focused on quantities of materials needed and quantities of direct labor needed to support that same production budget. The key transition is going from the production budget to materials needed, materials used to produce the finished goods. The saleable finished goods units must be first translated into raw material units such as pounds, gallons, etc. A conversion factor is needed to go from the production budget to the materials needed to support that production budget. So focusing on the manufacturing production budget first, we can use the base formula, and we're going to use units and not dollars. So we're concerned with the finished goods inventory account and what we need to add to that, in other words, produce to satisfy our sales forecast. The production budget is typically the unknown amount of finished goods to be produced, the A in the base formula. So once we're given sales units, we can back into the production units by also knowing the beginning and ending inventory required in finished goods. So we must calculate both B and A given S to back into A, current production budget in units. Moving to the formula for raw material purchases budgets, now we're going to use units first and convert these to purchases last. Again, the unknown element is the amount of purchase material needed to support a production budget. So it's A in the raw materials inventory account that we'll end up with. What item do we start with when configuring a raw materials purchase budget? We must know the production budget and the number of units required to support that production budget. In other words, S, the amount of materials consumed out of the raw materials inventory account to make our production. Once we're given S, we can back into the raw material purchase budget by again knowing our beginning and ending inventory raw materials. Once we have our units of raw materials we need to purchase, we can quickly dollarize them into dollars by multiplying times the raw material unit price. So it all starts with the sales budget and moves on to what production is needed to support sales, and we'll both deal with finished good units in this first step. The production budget shows the units that must be produced to meet anticipated sales. It's derived from the sales budget plus the desired change in ending finished goods inventory, which must be also calculated. So our formula is budgeted sales plus desired ending inventory minus beginning finished goods equals our required production units. If we had no change in ending inventory, let's say we had no beginning inventory, no ending inventory, our required units to be produced would simply be the units that are budgeted for sales. However, ongoing manufacturers will have beginning units on hand and desired targeted ending units. So that change in inventory works into what's required to be produced in the current period to satisfy current period sales and to have some left over to anticipate next period sales. We saw this sales example from a previous talk. For Hayes Company, our expected sales volumes are 3,000 units per quarter, increasing 500 units each quarter. Sales price $60 per unit. We'll primarily be working with the unit sales and its relationship to the next level of budgeting. In other words, how many units to produce to support this projected sales. Now, other than the sales forecast, we need to know how we arrive at our beginning and ending inventories of finished goods to support that sales forecast. Inventory on hand is necessary to prevent any sales loss if a surge in sales occurs in the beginning of the period. So, starting with our expected sales units, 3,000 first quarter, 3,500 second quarter, 4,000 and 4,500 in the last quarter. Our first question in the first quarter, how much to produce in total? How much ending inventory do we want at the end of the first quarter? 700 units. How do we calculate that? We'll be given an assumption based on next period's sales. So we can calculate 700 units that we want at the end of the first quarter by looking at the 3,500 units sales in the second quarter. In this case, taking 20% of that. That's our targeted ending inventory at the end of any quarter. The assumption on what the percent of ending inventory in relation to the next period's sales will always be given in a problem. And it'll be consistently used once established. So from 3,000 units to be sold, we want 700 units on hand. That means we must make a total of 3,700 units during the first quarter. However, our beginning finished goods inventory of 600 do not need to be made in the first quarter. They're already on hand. Again, the 700 units that we're going to make in the first quarter that we want on hand will be our starting point, beginning inventory in the second quarter, to take care of any sales surge we experience immediately. Likewise, in the second quarter, our ending inventory is 800, which is 20% of 4,000 units next quarter's sales. And likewise, at the end of the third quarter, we want 900 units on hand looking forward to the 4,500 units of sales required in the fourth quarter. Again, 20% of that is our ending inventory that we want made in the previous quarter. So going back to the first quarter, we need 3,700 units to support our sales. However, we don't need to produce that which is on hand at the beginning of the quarter. The 600 units would have been made back previous to the first quarter based on what? Look ahead to the 3,000 units of forecast the first quarter times the same 20% requirement, 600 units. That doesn't need to be made. It was previously made. We subtract that out of 3,700. Our current first quarter required production units, 3,100. So 3,100 units is our required production in the first quarter to support our sales of 3,000, plus have 700 on hand for the next quarter. Likewise, our planning in the second, third, and fourth quarter go through the same routines. Again, our production in any quarter always starts with sales of that current quarter. Second quarter, 3,500 required sales. We want 800 units on hand at the end of the second quarter. Total of 4,300 must be produced. However, 700 was on hand at the beginning of the quarter, not to be made. That's subtracted out. 3,600 units required production in our second quarter, and so on. So the required production units are the A to our base formula, the addition to finished goods of the present quarter. For our production budget now, let's move to our direct materials budget. This will show both the quantity and cost of direct materials to be purchased. The formula is given below. Now we're going from our production units required to support sales, which is always calculated first. This is the A in the finished goods inventory account. And from that production units, we need to know how many have to be purchased to support that. Again, we have a change in ending and beginning inventory of the direct or raw materials itself, affecting how much is to be purchased. So our formula, direct materials required to support production plus desired ending inventory minus beginning inventory on hand, does not need to be purchased presently, equals our required direct materials to be purchased in the current quarter. The budgeted cost of direct materials then is easily calculated. Required units to be purchased times anticipated cost per unit. That's our last and very quick computation, dollarizing the raw material purchase budget. Recapping that formula, we use units first and then convert those to dollars in our last step. So if we're given our consumed raw materials needed to support the production budget, derived from that production budget, our goal is to calculate how much raw materials must be purchased in the current period. That's calculated last after knowing our beginning and ending inventory of raw materials units. Backing into A, raw material purchase budget. Here's an illustration. The Hayes Company manufactures a product called Right Dried. It requires 2 pounds of raw materials for each finished goods unit, and the expected cost per pound is $4. This is the data to calculate the S, or the consumed amount of materials out of raw materials inventory. Now, Hayes maintains an ending inventory equal to 10% of the next quarter's production. We're also going to assume that the desired ending inventory of direct materials is 10,020 pounds for the fourth quarter of 2014. That's going to be given because we don't have the next year's sales forecast to back into it. That'll just be a given. Our challenge here is to prepare a direct materials budget for the year 2014 by quarter. First, the quantity to directly support the production budget, and then the quantity of raw materials to be purchased. So we'll first calculate S and then back into A. Our direct materials budget starts with our previous budget, our production budget. Units to be produced, saleable finished goods, 3,100 in the first quarter, 3,600 in the second quarter, etc. Now, this is our translation. We have to go from saleable units down to a more detailed level of raw materials. We're given that there's 2 pounds of raw materials required for each finished good, so multiply that finished saleable units times 2 pounds to arrive at our 6,200 units in the first quarter, total pounds needed to support that production. That's what we need to consume out of raw materials to support that production level. However, our final end game of the direct materials budget is to determine our direct materials purchased for the period. So we not only want to purchase that which is required to support our production budget, but our desired ending inventory, in this case, 720 pounds. How is that determined? Looking ahead to the next period's production needs of 7,200 pounds, 10% of that's what we want on hand at the end of the first quarter. So 720 must be purchased in the first quarter to be our beginning inventory of the second quarter. What doesn't need to be purchased in the first quarter? Our beginning raw material inventory of 620 pounds. How is that 620 calculated? That was bought in the previous period, looking ahead to the production requirements of the first quarter. We knew we were going to produce 6,200 in the first quarter, 10% of that, 620. that was purchased previously. So that's on hand and does not need to be purchased. So the B is subtracted out of the S plus E, leaving 6,300 pounds to be purchased in the first quarter by itself, the A of our base formula for our raw materials inventory account. We can quickly dollarize that, multiplying times $4 per pound. $25,200 is our required dollarized raw material purchase in the first quarter. I'll not go through the second, third, and fourth quarter. It's the same math. Again, starting with saleable units, exploding that down into a more detailed raw material budget, knowing how much we want on hand, must be purchased the current quarter, but we don't have to purchase that which was held over from the previous quarter. For instance, in the second quarter, the 720 pounds was purchased in the first quarter. That should not need to be purchased again in the second quarter. That's subtracted out from the 8,020, the S plus E. So our total direct materials purchases in the second quarter, 7,300 pounds. S plus E minus B, A, the additions to our raw materials in that second quarter, and likely dollarized down below. Please note that the assumption as to how much should be on hand, in this case 10% for raw materials, will be a given factor. Our raw material ending inventories as a percent of production are commonly different than our finished goods on hand in terms of sales, but assumption given to calculate ending inventories will be established in every problem given to you. A direct labor budget is similar to a direct material purchase budget, but simpler. It'll show the quantity of hours and cost of direct labor necessary to meet production requirements. In other words, we start with a production budget and determine how much labor is needed. In this case, direct labor time per unit. This is our labor content of each finished product. So units to be produced in a given period times its direct labor time per unit gives us total hours, and we simply dollarize those times the direct labor cost per hour to come up with our total direct labor cost. Calculate hours first, dollarize them secondly. Here's an illustration of a direct labor budget. Hayes determines that it needs 2 hours of direct labor for each unit produced of finished goods. Anticipated hourly wage is $10 per hour. So again, starting with our production budget, units to be produced, first quarter, 3,100 units. So that content factor, 2 hours per unit, allows us to explode our saleable units of 3,100, needing 6,200 labor hours to produce 3,100 units of saleable product. Those hours times our cost per hour, $10, gives us our total direct labor budget of $62,000 for the first quarter. Again, calculate hours first, quantity, dollarize them second. The direct labor budget for succeeding quarters are calculated likewise, exploding the production budget down to its detailed labor hours required and then dollarizing it. So our total direct labor budget for the year is $308,000, simply the sum of the 4 quarters' labor requirements. Let's do an example of a comprehensive problem. We're given sales forecasts and are asked to complete a production budget, then calculate the direct materials required to support that production budget and the follow-on necessary purchases of raw materials to support the raw materials usages calculation. The only item missing is the direct labor budget, which is much simpler because we do not purchase and store our labor in advance. Note our key assumptions for required beginning and ending inventories. For saleable finished goods, it is 25% of the next quarter's sales volume. For raw materials, it is 5% of the next quarter's production requirements. We we need to be able to calculate the B and E of our respective inventory accounts to allow us to back into the A, or addition, of the base inventory formula, along with deriving or knowing the S quantity, or the quantity that is subtracted out of those respective inventory accounts. So here's our starting point, the sales by quarter. Let's just lay those in from our given data. Expected unit sales of 240,000 units in the first quarter, 300,000 in the second quarter, 360,000 in the third, and 300,000 in the fourth quarter. Even though we have those extended at the selling price, for our production purposes, we just need the unit sales numbers from this sales forecast. Here's our schedule to calculate the production budget for Soriano Company. Our goal is to calculate the required production units. Units need to be made to add to our finished product inventory, the A in the base formula for the finished goods account. So our starting point, expected unit sales, first quarter, 240,000 units, second quarter, 300,000 units, third quarter, 360,000 units, and fourth quarter, 300,000 units. Our first calculation is to add in a desired ending inventory of finished goods, our E. That's going to be based on 25% of the next quarter's sales of 300,000. That calculation, 75,000 units are required at quarter end. Simply add up our total required units, our total outcome, if you will, 315,000 units in the first quarter. Now let's look at our sources. Beginning inventory, 60,000 units, which was made in the previous year, the quarter before the first quarter. That is 25% of 240,000 units, gives us our 60,000 units beginning finished goods inventory. We back into our required production units of the first quarter, 255,000 units. The total outcome, S plus E, 315,000 units, and how they're sourced. Beginning inventory, 60,000, and our current production of the quarter, 255,000 units. Second quarter, similar calculations. Beginning sales units, and our required ending inventory of 90,000 units, which is 25% of the next quarter's sales of 360,000 units. Add those together, S plus E. Our beginning inventory is the ending inventory of the previous quarter, or 75,000 units. Back that out of our total outcome. We're required to produce 315,000 units for the second quarter. Third quarter, beginning with sales, laying in our ending inventory, 25% of next quarter's sales. Subtotal that. Subtract out our beginning finished goods inventory, which was the ending of the previous quarter. We must produce 345,000 units in the third quarter. Fourth quarter, 66,000 units ending inventory. That's 25% of the next quarter's sales of 264,000 units. Subtotal our total outcome. Subtract out our beginning inventory, prior quarter's ending inventory. In the fourth quarter, we must make 291,000 finished saleable units. Total for the year, 1,206,000. Again, these are finished good units. These are additions to the finished goods inventory account. A quick recap of the first quarter calculation only of required production using a T account. We calculated a total required production of 255,000 units to be produced during the quarter. That was a result of knowing our total sales of 240,000 units and being able to calculate our beginning and ending inventory values as indicated. Let's do a direct materials budget. Here's our schedule. We're going to start with our units to be produced. In other words, our starting point is our production budget to determine our direct materials budget. The first thing we have to do is translate that production budget into total pounds needed. So translating our finished goods units into a lower level of raw material units or pounds. We're given the assumption that the direct materials per unit is 3 pounds per finished goods. Again, that always must be specified in the problem. What I call our content factor, amount of raw materials per finished good unit. Multiply that times our saleable units. First quarter, we need 765,000 pounds of materials to support that production budget. So the total pounds needed for production will be coming out of the raw materials inventory account, but we also need to calculate our direct materials purchases for that quarter. So we need our beginning, ending inventory levels for raw materials for the first quarter. Desired ending raw materials inventory will be 5% of the next quarter's production requirements of 945,000 pounds. And so therefore 5% of that, 47,250 is our desired ending inventory. Add up total pounds to be consumed, 765, plus our ending inventory of 47,250 gives us our S plus E, our total outcome, 812,250 pounds. How is that sourced? Beginning inventory, 38,250, and we back into our additions or our purchases for the quarter, 774,000 pounds of raw materials required to be purchased in the first quarter. We can quickly dollarize that by multiplying those pounds times cost per pound of $5. Total purchase budget for the first quarter, $3,870,000. Let's recap that first quarter calculation of raw material purchases using a T account for raw materials inventory. Again, we backed into our total purchase required of 774,000 pounds. By knowing how much had to be used, we derived that from our production budget. We also had to calculate our beginning and ending inventories to back into that A in the base formula of 774,000 pounds to be purchased. Again, calculate units first and then convert purchases to dollars as the last step. Review question. A sales budget is management's best estimate of sales revenue for the year. A sales budget is not the starting point of the master budget, it is the starting point. The budget income statement is the final resting point of the operating budgets. It's an important end product. It indicates expected profitability of operation and will provide a basis for evaluating the company's performance. That budgeted or forecast income statement is derived from all the previous operating budgets: sales, direct materials required, direct labor, manufacturing overhead, and selling administrative expense. In this chapter, I'm not concerned with calculating the manufacturing overhead or selling administrative expense budget. Just be aware they're part of the components, though, of the total budgeted income statement. Here's an example of a typical problem you might find on the exam. We're asked to determine the total budgeted cost of goods manufactured for the current period. Right away, we must realize the cost of goods manufactured comes out of our finished goods inventory account. So we're given that a company determined that the budgeted cost of producing a product is $8 per unit. Other assumptions: the on-hand June 1st or beginning inventory were 70,000 units of saleable goods. Desired ending inventory, 110,000 units. And the sales department budgeted sales of 250,000 units during the month of June. So the question is, what is our budgeted cost of goods manufactured for the month of June? First, let's do a T account for the finished goods inventory account. This will quickly calculate the COGM, or cost of goods manufactured units, needed to be produced. In other words, the production budget. So finished goods inventory, these are all in units. 70,000 beginning, 110,000 ending, sales of 250,000. We need to back into the additions to finished goods, or cost of goods manufactured, for the month. Again, COGM is the addition to the finished goods inventory account. What does A calculate out to be? A is the additions, and is quickly calculated to be 290,000 units. We know that the final status total of the units sold, S, and the ending inventory on hand, E, must first be available. The S plus E is what I call the outcome to our problem. So our outcome is sourced by what? Our beginning inventory and our additions. So S plus E minus B will equal the A, or additions, to our problem, the cost of goods manufactured. So our COGM calculation in units is 290,000 units, additions to finished goods inventory. We'll dollarize that at $8 per unit of production cost. $2,320,000 is the answer. Review question. Each of the following budgets is used in preparing the budgeted income statement except the capital expenditure budget. That becomes a component of the cash budget, not the operating budget. We haven't looked at the cash budget yet. That's a financial budget. We'll look at that in the next talk. I'd like to make a brief comment about budgeting for non-manufacturing companies, retailers, merchandisers. The sales budget is also the starting point and key factor in developing the master budget, but merchandisers will use a purchases budget, not a production budget. They're not producing their goods, they're buying them from a manufacturer. So we do not use manufacturing budgets such as direct materials, direct labor, and overhead. So a retailer wants to determine the budgeted merchandise purchases, required merchandise purchases for a period in time. We have a very similar formula here. B plus A, beginning inventory plus purchases. That's our source. What's our outcome? That which will be sold, cost of goods sold, and desired ending inventory. So our base formula is also in use for merchandisers. Question. The budget for a merchandiser differs from a budget for a manufacturer because both A and B. A merchandise purchase budget replaces the production budget, and manufacturing budgets are not applicable. The retailer is not making them, they're buying them from a manufacturer. Review illustration for a merchandiser or retailer. The key inventory count is merchandise inventory. An inventory flow formula introduced in notes in prior chapters and in this chapter for manufacturers applies here as well. Typically, the unknown is the amount of merchandise inventory to be purchased. This is the A in the base formula. A merchandise inventory count is similar to a finished goods inventory count for a manufacturer. B plus A, our sourcing. S plus E, our outcome. Either we've sold what we have on hand or it's still in ending inventory. If we're given cost of goods sold, we can back into purchases. We need to know our beginning and ending inventory though. So B plus A is our source, S plus E is our outcome. We solve for A by subtracting out beginning inventories from our total outcome, S plus E. Review for manufacturers. Everything starts with sales forecast. Driving a production budget in units. deriving materials used to support that production budget. We must translate finished goods saleable product to the needed lower level of raw material measure, and then back into a raw material purchase budget. Units first, dollars second. Plus we have direct labor requirements, which are derived directly from the production budget, given a content factor of number of hours required per finished unit. Again, we skip over the work in process inventory that's not budgeted by planners.